For more movers, let's welcome in Diane King Hall, host of Morning Movers. And Tapestry is moving quite significantly right now. Talk us through it.
Yeah,
thread the needle there.
I know. This one is down double digits today. Are people still buying handbags? Yes. So you had strength in Coach, but you have weakness in Kate Spade. But it's not just about that weakness in one segment. It's also about the projections of what's to come and the hit that can come from tariffs as it relates to the parent company. So for its most recent quarter, it did report an increase in revenue. It was up 8% year over year, $1.72 billion. The greatest strength was in Coach. Coach is the it girl once again. That sales there 14% higher. You still see weakness in Kate Spade. Kate Spade was down 13% year over year. Adjusted EPS coming in at $1.04. That did beat consensus. So it did beat on both the top and bottom line. When you look at the numbers, though, they had this impairment charge tied to Kate Spade. They want to try to do the same thing with Kate Spade that they did with Coach, and make Kate Spade that girl again. We'll see if they can actually do that. In terms of their forecast, and this is one of the reasons the stock is getting hit, the revenue forecast, they're forecasting $7.2 billion for the full year. That's actually slightly above consensus, but adjusted EPS, that's actually below consensus. They're projecting a range of between $5.30 to $5.45. What does that outlook include? That includes a hit from tariffs. So that's one of the challenges. They're expecting some $160 million in total tariff costs. And obviously that weighs on profitability. I was talking earlier to Joe Brusuelis, the chief economist over at RSM. Sam, and one of the things he talked about is thinner margins that companies are going to have to deal with. He was talking about that as it relates to PPI, because he said what PPI showed is that companies or the foreign producers are not taking the hit, like we said, like that foreign producers would pay the prices of these tariffs. And so the companies are only going to be able to maintain thin margins for so long before they pass some of this off to consumers. So tariffs weighing heavily on their outlook from here. That's the main driver, they say, as the reason for their earnings forecast. Their production is concentrated in Vietnam, so we have exposure there as it relates to tariffs. You'll recall when that first big tariff announcement came in, we weren't expecting the level that we saw on Vietnam. They have exposure to Cambodia, the Philippines, and India, so those imports are vulnerable to U.S. duties. Yeah, all countries and markets that we've seen being hit and very much the target of Trump's duties there. I'm just wondering, as far as the whole earnings picture is concerned, when we've heard from a number of these types of retailers, I mean, as soon as you mention the T word, particularly if you're talking about sort of the hit to margins, I mean, that's where you've seen the stocks get punished. I'm just wondering, how this sort of fits within the sort of broad spectrum of the other retailers and what sort of the analysts are saying about that. Well, you've seen similar hits within the luxury space. Now, Tapestry is not considered the highest of the high. Obviously, you think about like LVMH, for instance, in that respect. So Tapestry had been a winner in this environment as the consumer becomes choosier, right? And then they've been leaning into Gen Z. Gen Z's really liking, for instance, Coach. So, look, to be fair, even with today's move, it is a sharp move that you can't ignore, and the T word obviously matters, causing trouble for Tapestry. But the stock has been up year to date. The stock has been an outperformer year to date. When I look at its performance, even including today's move, it's still up more than 45%. And that's with this leg down of 16%. Yeah, and it's fascinating that you tie in the PPI, because what we've heard is the margins are up 2%. So there has been a lot of conversations about, where in the supply chain some of these companies are actually going to be able to absorb the cost and when they might ultimately have to pass that on to the consumer. We've got a lot of earnings to get through. The next cab off the rank is a very different business, and that is Cisco. What are you seeing there? So Cisco, they actually reported a pretty solid quarter overall. The stock is getting hit slightly today. It's down, though, by less than 1%. And that stock has also been an outperformer compared to the S&P 500 year to date. Not as strong as Tapestry, but obviously, as you mentioned, a very different sector, up more than 17% year to date. In terms of its most recent quarter, for its fiscal fourth quarter, they reported adjusted EPS of 99 cents. That beat expectations. It was a narrow beat, but a beat nonetheless. Revenue came in at $14.67 billion, also better than expected. Revenue was actually up 7.6% year over year. In terms of their guidance for their fiscal first quarter, they're guiding for a range of between 97 to 99 cents. And then revenue, they're guiding for 14.65 billion to 14.85 billion. So somewhere around basically where they, what revenue was for this most recent quarter, to slightly higher than that. That is actually above consensus. So that may explain also the range-bound activity that we're seeing in the price action today. For the full fiscal year, they're guiding for EPS to come in between $4 to 406. Revenue, they're guiding for between 59 to 60 billion. That is in line with estimates. In terms of some highlights, networking was up 12% year over year. Security up 9% year over year, Sam.
Yeah, I was speaking to Marley Hayden about this yesterday, about how, ahead of the earnings, they'd set a pretty high bar. They also have to sort of justify this rally that they've seen, almost 60%, I believe, over the last year or so. The valuation, though, it is cheaper, but we've also seen the sell-side analyst community responding to this with some price target boosts I've seen from Barclays and the Bank of America. Talk us through what they're thinking.
So overall, what I'm seeing is very constructive, still largely leaning bullish. Wells Fargo is raising their price target to 83. They are overweight, so we know that's essentially the equivalent of a buy rating. JP Morgan Chase raising their price target as well on Cisco to $80. They are still maintaining overweight, so also bullish. Piper Sandler, they are neutral. They're maintaining a neutral rating. They're raising their price target to $70, essentially around where we are right now on this one. You mentioned Barclays. They are also neutral on this one, but they are raising their price target to $71. Rosenblatt is a buy on this one. They've got an $87 price target. B of A, as you mentioned, they are out on this one, or excuse me, by out I mean they are out with their adjusted target on this one. Their new target is an increase to $85. They are a buy. They see this as a buy for Cisco. So you've got a lot of bullish sentiment around this. Cisco's got a surge of orders from the big tech sector, massive AI data centers. They run the LLMs, the other AI tools. They pointed out, these are some of the highlights they pointed out off the back of their latest earnings. Those companies, these major companies, ordered some $800 million worth of Cisco networking gear. We look at our computers and we see Cisco as part of the backbone of this. For the entire fiscal year, AI orders totaled over $2 billion. That's twice what Cisco set as its target. So it really was firing on all cylinders. About half of that is for those backbone networks that connect thousands of those GPUs, those powerful units that do the heavy lifting for AI. So Cisco really a key part of this, new frontier that we talked about. They've got these new high-speed switches and routers that can handle the extreme data demands that AI training and processing require. So it's not just the big tech giants. Cisco says, there's also large corporations outside of the tech sector that they're working with, for instance, in finance, like BlackRock.
Oh, absolutely. Yeah. I mean, it's the whole ecosystem, isn't it? And I mean, you really do need the networking and some of the infrastructure, as you've been reporting on as well. Just last but not least, Deere on the move lower this morning. What gives?
Yeah, so Deere is under some pressure. I'll go through some of the numbers really quickly. In terms of how they performed, revenue was $10.36 billion. They're also cutting their profit outlook, so that's one of the issues here. They've narrowed their guidance. Revenue down 9% year over year, so that's one of the challenges here. Adjusted EPS came in at $4.75. That was better than expected. I'm sorry, revenue came in at $12 billion. That was better than the street was looking for, just over $10 billion. So again, although that was better than expected, their guidance is the issue here. They've narrowed their third quarter profit outlook. Their full year outlook, they've also narrowed that as well. Their full year outlook, net income, they're guiding for 4.75 to 5.25 billion. They are maintaining their forecast for some sectors, production and precision. That's still down, though, this year. That's been one of the challenges in some quarters. Construction and forestry sales, that's also down. Small agriculture and turf sales, that's now expected to decline about 10% versus their prior forecast. In production and precision, again, that they've been experiencing some lower shipment volumes, weaker than expected pricing. Pricing has been a challenge for Deere, and that is something that's hitting the stock today. The CEO cites, quote, challenging times, weaker volumes, high levels of used equipment weighing on the market. So if people are still utilizing used equipment longer, they don't need the new equipment.
Yeah, absolutely. And I mean, this is just another example of what we've seen time and time again in this earnings season. A beat on earnings, but just still not enough. And really that guidance being the fly in the ointment. Thank you so much for getting us across those key stories, Diane.